Are you scared yet? Are the red days in the market making you feel anxious? Have you considered selling some of your stock yet? Are you wondering what to do next? Well, if so, keep watching because in today's video, I'm going to be telling you exactly why stocks keep falling, what to expect next, and exactly what I'm doing with my personal stock portfolio. What's up, everybody? It's Prashant here. Welcome to my YouTube channel and thank you for joining me today. Before we get any further, I want to take a second to ask you to smash the like button and the subscribe button for the YouTube algorithm. That being said, let's get back to it. There's a saying out there, sell in May and go away. This is based on the fact that typically the stock market has more modest gains in the May to October timeframe, especially when compared to the November through April timeframe. Me personally, I don't believe in this at all. I believe that time in the market is better than timing the market. In fact, let's look at the data from just this year. On May 3rd, 2021, the first day of trading in May, VOO, Vanguard's S&P 500, was trading at around $384. On September 1st, it was trading at $416. If you had sold your stock in VOO in May, you would have missed a potential upside of $32 per share. This means that if you had sold $10,000 worth of VOO shares back in May, you would have missed out on a gain of $833 or 8.3% in just 6 months. Instead, you would have to figure out what to do with $10,000 in cash, potentially pay some capital gains tax because let's be real, if you've been holding S&P 500 shares over the last few years, you have made money on them, and also rebuy into the market at a higher price point now in October. Since the market drop of March of 2020, the stock market has done exceptionally well all the way to September of 2021. It is widely known that September is typically the worst month for stocks, and this year has been a startling example of this trend. After hitting an all-time high of $416 on September 1st, VOO has been taking a beating and it is now currently trading around the $395 level, basically about 5% down. And the Dow Jones is about 4.5% down. And that is even after the rise in stocks today. And let's talk about some individual stocks. Facebook is down about $57 or 13.5%, especially after the recent whistleblower report, the Senate hearing, as well as the hours-long outage of all Facebook services, including Facebook, Instagram, Messenger, and WhatsApp yesterday. Apple is down about 11%, Alphabet, the parent company of Google and YouTube, is down about 8%, and Boeing is down about 6%. The list goes on and on and on. There has been pain in the market, no matter what industry or sector you invest in. Basically, if you're invested in stocks, chances are this has negatively affected you. According to a recent article by CNBC, 41% of all US household wealth is currently held in stocks. This is a record high level. This means that of every $100 of US household wealth, $41 is invested in stocks. Basically, everyone has a very high exposure to stocks right now. This means that if the market starts getting rocky and starts having red days, the pain will be real and widespread. And this is exactly what has been happening over the last few weeks. Obviously, it is impossible to definitively say why the stock market is going down right now. Even Warren Buffett cannot do that. But if we think about the economic and political situation we are in right now, we can piece together the bits of news we have into a theory. Here we go. Let's think about what's happening in the world right now. Thankfully, the pandemic seems to be abating, which is a good thing. But this also means that the Fed is expected to roll back its easy money policies as well as trim its bond purchasing program. While this is widely expected, the stock market does tend to overreact to negative news. So I think this could definitely be a headwind to the stock market right now. Next, we need to remember that the Evergrande crisis is not over. We don't really know what the ultimate fate of this company will be. We don't really have clarity if this company has been able to make its outstanding debt payments, which were due late September. And we don't know if there is a risk of contagion to the broader financial markets all around the world. Fed Chair Jerome Powell says that there is no risk of contagion. However, some analysts disagree. I think till we know what happens to Evergrande one way or another, we are not out of the weeds, and this could be a headwind to US stocks right now as well. The next thing to think about is US politics. Last week, the US government narrowly avoided a shutdown by passing a continuing resolution. What this means is basically it's a stopgap measure to fund the government at its current levels for a few more weeks. This time it's December 3rd. At that time, they would have to either pass a budget or issue another continuing legislation. But the more important thing is the US debt ceiling. If you don't know what the debt ceiling is, I did a video about this last week that you should definitely check out after this one. Anyway, the US is scheduled to run out of money on October 18th. If this happens, the US will not be able to pay back on its debts, and this can cause untold havoc on the world financial markets. Personally, I don't think this will be allowed to happen. I think Republicans and Democrats alike understand the risks of a US debt default, and honestly, they probably want to protect their own investments. So I don't think they will allow this to happen. However, the market, like I said, does tend to overreact to negative news, and I do believe that this is a strong headwind against the stock market right now. So when you look at all of these factors, it is kind of easy to see why the stock market has been declining over the last few weeks. Broadly speaking, we are about 5 to 10% down from all-time highs, depending on the index or individual stock you're looking at. So, will this continue? And if yes, how much further do we have to fall? Well, it's hard to say. Even though the stock market rose a little today, I do think that we will trade sideways or maybe even slide down a little bit further. I think these following things need to happen before we can really get out of the stock market slump. Number 1, continued improvement in the fight against COVID. Number 2, resolution of the Evergrande crisis. Number 3, raising of the US debt ceiling. Number 4, good jobs reports consistently, which basically means more and more jobs are added every week. And number 5, an inflection in the inflation rate. Currently, inflation rate year over year is hovering around 5%, which makes investors pretty nervous and they kind of want to hold on to their cash. However, if this inflation rate starts inflecting downward, they will become more and more confident and they will start spending and investing their money back into the stock market, which should naturally increase the prices in the stock market and thus increase the returns that it's giving. All that said, you guys, now let's talk about what I'm doing in this market. Remember what I said earlier, time in the market is better than timing the market? I live by those words. So this is what I'm going to do. Now remember, this is not investment advice, this is just my opinion. The very first thing that I'm doing is that I'm not selling. I am diamond handing this market. 99.9% of my stock holdings are long-term plays, and I believe I'll be holding these stocks for decades to come. Because I have such a long time horizon, I am not bothered by what's going on in the stock market right now. I believe that these are usual tremors and eventually we will be just fine. The second thing that I'm doing is that I'm adding cash to my tax-advantaged accounts. In fact, only last week I maxed out my Roth IRA account for a maximum contribution of $6,000 for this year. My usual plan is to invest $500 every month into my Roth IRA to come up with the $6,000 by the end of the year. But last week, I ended up putting $1,500 for the months of October, November, and December to get to that $6,000 mark early. And only yesterday, I actually bought more stocks. I went and bought my favorite ETFs, VOO, Vanguard's S&P 500 fund, and VGT, Vanguard's tech fund. Now, I know there is some duplication, especially because tech stocks are such a big part of the S&P 500 now, but I'm okay with this duplication. I believe that tech stocks will continue to see explosive growth over the next few decades, and I want to be able to ride that wave. The third thing that I'm going to do is that I'm going to try and save every extra little bit of cash that I can. If I find $50 in my budget that I haven't spent, I'm going to save it. My hope is to have a small amount of money ready to go just in case something happens. My biggest regret back in the 2020 market crash is that I did not put more money into it. At the time, I had some money saved up and I was dollar cost averaging into the market. But when the market fell, I got scared and I did not put the money lump sum into the market. I was trying to time the bottom. Unfortunately, I missed it. But luckily for me, at least I kept dollar cost averaging in. But this time I'll be ready. If there's another drop in the market, maybe even 5% to the downside, I will put whatever extra cash I have saved up into the S&P 500. So that's all I have for you guys in today's video. Now you know what I think of today's stock market and what I'm doing in the face of declining stocks and a string of red days. Not panicking, remembering I'm in this for the long term, and getting cash ready if an opportunity shows up. Please smash the like button and the subscribe button for the YouTube algorithm and leave your thoughts in the comment section down below. Please go ahead and click the bell icon to be notified instantly when I post a new video. I've been trying to post 2 new videos every week now with great new financial content, and I would love to see you back on the channel. Go ahead and follow me on Instagram and TikTok. Thank you for watching and see you next time.